The Precious Metals Week in Review, January 29, 2016. Brought to you by Precious Metals International. Stock markets remained volatile this week as global central banks continued their reactionary tactics to try to stimulate their respective economies further. The continued suppression in the price of oil also remains a factor in stock performance, particularly in emerging markets. The number of Americans filing new claims for state unemployment plunged from a 6-month high last week, falling 16,000 claims to a new level of 278,000. The previous week's data was revised to show an additional 1,000 claims. Trouble adjusting for seasonal volatility due largely to this year's unusual weather patterns may continue to create extreme variations in the weekly unemployment data. All eyes will now turn to the first non-farm payrolls NFP report for 2016 for indications on the Federal Reserve's next move regarding interest rates in the U.S. The NFP report is due out next Friday. The pace of U.S. economic growth slowed slightly more than expected in the fourth quarter, with gross domestic product (GDP) coming in at a growth rate of just 0.7% as businesses work to reduce excess inventories. A stronger U.S. dollar and weakening global demand also weighed on U.S. exports in the fourth quarter, exacerbating the inventory issue. The Bank of Japan (BOJ) shocked economists and financial analysts around the world this week by taking interest rates negative in Japan for the first time ever. The BOJ said that it will apply a rate of negative 0.1% to excess reserves that financial institutions deposit with the bank beginning on February 16th. The central bank hopes that the move will push banks to lend more, which would in turn provide stimulus to the economy and help the bank hit its 2% inflation target. The BOJ left its quantitative easing plan unchanged and noted that global financial markets have been volatile against the backdrop of the further decline in crude oil prices and uncertainty such as over future developments in emerging and commodity exporting economies, particularly the Chinese economy. In the U.S. Congress, lawmakers have begun to put into action additional programs that would place sanctions on North Korea for its continued ambitions toward arming itself with a nuclear arsenal. The Senate Foreign Relations Committee approved legislation on Thursday that would create additional sanctions against North Korea over its nuclear program, continued human rights abuses, and its increasing cyber warfare activities. The full Senate is reported to begin considering the new measure the week of February 8th. The House of Representatives has already passed its own similar legislation by a vote of 418 to 2, and it appears likely that the new sanctions against North Korea, whatever the form, will easily pass through Congress. Japan's Kyodo News reported Thursday, citing a government source familiar with the matter, that satellite imagery of North Korea could be showing preparations for the launch of a long-range ballistic missile in as soon as a week's time. On Wednesday, U.S. Secretary of State John Kerry met with Chinese Foreign Minister Wang Yi, and both apparently agreed on the need for a significant new UN security resolution to address North Korea's ongoing violation of previous Security Council resolutions against its nuclear ambitions. The move comes after a January 6 nuclear test, which North Korea claimed was the detonation of its first hydrogen bomb. Crude oil prices rallied this week, climbing back above $30 a barrel on the likely false hope that Russia and OPEC can come to some sort of agreement on a production cut to stabilize prices. It is highly unlikely that OPEC and non-member country Russia will even begin to have any constructive discussion on how to stabilize the price of oil, much less cutting production to boost prices. The euro climbed against the US dollar for much of the week, but then plunged as the end of the week approached and the Bank of Japan announced it was moving interest rates into negative territory. The euro closed the week only slightly higher against the US dollar. The Japanese yen moved essentially sideways against the US dollar for most of the week, but took a plunge on Friday following the BOJ's announcement. The yen will close the week lower against the US dollar. The U.S. Federal Reserve seemed to strike a cautious tone in the latest statement that was released at the conclusion of its first Federal Open Market Committee meeting, FOMC, of 2016 this week. A stronger U.S. dollar combined with the continued glut in world oil supplies and global recessionary pressures are all acting to weaken the U.S. economy, which is currently being held up as one of the lone economic bright spots as the rest of the world economies continue to struggle. Economic data in China continues to suggest that there is further economic sluggishness ahead for the world's second largest economy. The accompanying slowdown in oil, steel, and other commodities as Chinese demand falters appears to be aggravating conditions in other global economies, especially emerging markets. The Bank of Japan, BOJ, seeing further dangers to the Japanese economy due to China's ongoing slowdown, took the drastic step of taking interest rates negative this week in an effort to force banks to lend money and hopefully assist in pushing the slowing inflation rate back towards the BOJ's stated target of 2%. The U.S. Federal Reserve made no changes to its monetary policy at its first FOMC meeting. In December, the Fed stated that it would like to follow through on its first interest rate hike in more than a decade with at least another 4 rate hikes in 2016. Analysts are projecting that the global economic picture has changed in such a fashion since December's rate hike that the Fed will be forced to hold off on any further rate hikes in 2016, trapped by the faltering global economy and held hostage by the increasing volatility in stock markets. Global geopolitics and faltering economies appear to all be acting to increase volatility in global stock markets. Some analysts are even projecting that the Fed may be forced to re-implement a quantitative easing program or even cut interest rates back to their record lows as global economies continue to falter. Precious metals prices have continued to consolidate around their current levels as stock markets have swung wildly back and forth under a pall of uncertainty. In uncertain times such as these, wise investors have continued to follow through on their plans to acquire additional physical precious metals as part of a well-diversified investment portfolio. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, January 29, 2016. Brought to you by Precious Metals International.